If you haven't watched my video on shameless cloning, then shame on you. I mean, seriously, not only is this the most viewed video on my channel with over 8 lakh views, but the single video has pulled in almost 1.5 lakhs in revenue. It has brought in a tenth of my total subscribers. And if that isn't impressive enough, Business Today even turned it into an article. It's been a year since that video went live. A lot has happened since, and a lot is still happening, which has shaken the confidence of many small and microcap investors. And not just retail investors, even the biggies, even Ashish Kacholia wasn't spared, with his portfolio correcting by 20, maybe 30% from its all-time highs. So that's really what prompted this video. I wanted to review our earlier copycat methodology to see if there are ways of improving it. And secondly, I wanted to assess where things stand today in terms of performance. तो चलिए शुरू करते हैं. Okay, so very quickly, here's how the original shameless cloning strategy worked. We start with some 10 marquee investors and only those companies where they held at least 1% of outstanding shares as of December 2023. I then selected the top 3, 4, 5 stocks from each investor, narrowing the list to some 57 companies. I then complicated things a bit by simulating entry and exit points at the end of every quarter. It's something many commenters pointed out too, probably assuming that I have a hotline connect with the KDRs, Kacholias and Junjunwalas, which I don't. But the good thing is, in spite of these shortcomings and in terms of performance, our original cloning strategy did pretty well, delivering an annualized return of 41.4%. Now, 41 is a great number, but we can't deny the fact that this measurement, 41%, was taken when the bull market was in full flow. And secondly, as a strategy, I felt it was a bit complicated and difficult to execute. So that's when I went back to the drawing board, and what resulted was a revised copycat investing strategy with two major changes. The first change was an overhaul of the method itself. You see, in version 1, we were working on quarter-end disclosures, which means by the time one of our marquee investors buys or sells a stock, it's already a month or two by the time we get to process that information. So the modification I made is that we'll now be using real-time data, that is, buying information that is being reported to the exchange on the very same day or at best the next day. For example, just last month on the 24th of March, Mr. Madhusudan Kela bought some 9.5 lakh shares of SG Finserv at 350 rupees a share. This comes to 1.7% of the company's outstanding shares, and unlike version 1 where we would have waited for Mr. Kela or the company to declare it at the end of that quarter, in our revised shameless cloning strategy, we'll now be using this information as it happened. As to where I got this, the source, I picked this one from a screening platform called Tickertape, although I'm sure there are a number of websites and apps that compile such information, including the NSE website. The specific terms we are tracking are all related to large volume transaction disclosures, so things like a bulk deal, which is when an investor buys or sells at least 0.5% of a company's total shares in a single trading session. Then there's block deal, which is a pre-arranged trade involving at least 5 lakh shares or 10 crores worth of it in value. Thirdly, there's insider trading, the buying or selling of shares based on non-public, price-sensitive information. And finally, SAST disclosure rules become applicable when someone acquires 5% or more in a listed company or if they cross 25%, post which an open offer must be made. Using these almost real-time transactions not only improves the cloning strategy structurally, but it also addresses some of the timing-related comments that have been raised in my previous approach. The second major change I effected this time around is that instead of exiting at different points of time, I opted for a lazier approach wherein while I buy the stock whenever the marquee investor buys it, but when it comes to exiting, I simply sell it after a fixed period of time, which can be a couple of months or maybe a couple of years later. So as a process, I'm not waiting for the investor to sell their shares. I'm proactively doing that by buying and then actively selling those shares. This part will become a lot clearer when we come to the results, but a concern that often pops up with this frequent buying and selling of securities is the brokerage fee. I'm sure you know this, a high cost of brokerage not only reduces an investor's profit, but it also discourages important tactical moves like using a stop loss, portfolio rebalancing, position averaging, etc. So a high brokerage is definitely a problem, and that's where Stoxkart, the sponsors of today's video, comes in. Part of the SMC group, Stoxkart is a leading brokerage platform that's trusted by over 2 lakh customers for its seamless trading experience across web and on mobile. To tackle the problem of high brokerage fees, Stoxkart has recently introduced their SmartTrader plan, which is a flat and fixed subscription of just 99 rupees a month for unlimited number of trades. Yes, you heard that right, unlimited. And that too at just 99 rupees a month. And if you want an even better deal, then opt for the annual option, which comes at just 699. I know this is one ridiculously sweet deal for anyone who's an active trader, but wait, that's not all. Stoxkart also offers order slicing that automatically breaks large orders into smaller ones, advanced charting tools that help you analyze multiple stocks and market trends simultaneously, one-click order placement for instant execution of trades, real-time insights into the complete option chain and the most actively traded options, in-depth stock research and expert recommendations that help you make informed investment decisions, and price updates are now lightning fast with live market movements to help you stay ahead of others. So, trust check, technology check, features check, pricing check. Actually, that's a super check. So essentially, Stoxkart has everything you want in a modern tech-savvy broking platform. So stop overpaying for brokerage and explore Stoxkart now. As always, the link to the platform is available in this video's description. Right, so let's get back to our modified shamelessly cloned strategy, and here are the exact steps I took to implement it. Actually, this was done in two parts. The first part was more about extracting and cleaning up, which started with identifying a few well-known investors, and here's the list that I worked on. I then extracted the buy transactions from the 1st of April 2021 until the 28th of March 2025. So a solid 4 years of bulk deals, block deals, insider trades and SAST transactions. And thirdly, as a quick filter, I knocked off the low value transactions. So what you see in this list are buy transactions of at least 1 crore and upwards. This left me with some 93 transactions from 17 different investors and very well diversified, spread across 80 different stocks, which is okay because we're trying to build a broadish portfolio here. The second part of our execution is the analysis, which involves examining the gains and losses from each of these 93 transactions based on different holding periods. So since our review period was 4 years, I chose a 3-month and 6-month holding for short-term analysis and a 1-year and 2-year holding for a long-term evaluation. So let's start with the 3-month holding period, and had I simply bought these stocks on the date of announcement and had sold them exactly 3 months later, then as a portfolio, this quick buy-sell transaction would have delivered an absolute return of 14.5%. Of course, there were times when the market was really hot, sometimes it was down, flat, etc. But just to benchmark, had I invested this money in the small cap index, the Nifty Small Cap 250, on those exact same dates, and had I exited 3 months later, my returns would have been a mere 5.3%. 9% is of course a decently big differential, but as I said, this is not as simple as it looks, especially in the last 4 years with the market swinging quite a bit. Okay, now let's look at the 6-month carry, and while the Nifty Small Cap 250 delivered 12% returns on a rolling basis, our modified shamelessly cloned portfolio did a lot better, returning a little over 21%. On a 1-year basis, the performance gap narrows significantly to just 5%, but again on a 2-year carry, and even after removing the outliers, we see the difference has widened to an impressive 15%. Undoubtedly, 15 is quite substantial, but here's the catch. Notice what we did. We examined the 2021 data against 23, a bull run, and then we examined 2022 against 24, another bull year. And I feel this is what has significantly inflated the numbers, at least from a 2-year perspective. So just to close loop this, I tried out another scenario where instead of buying and selling at fixed intervals, I ran a simulation wherein had I simply bought all 93 stocks at the time of disclosure and had held on to them until today, that is the 28th of March 2025, then this portfolio would have yielded us a return of 24.7%, while an equivalent investment in the Nifty Small Cap 250 index would have delivered just 17%. So we are back to a 5 to 7% performance gap, and from the looks of of it, this seems to be the kind of outperformance one should expect from our shameless cloning strategy over the long term. Of course, this is just an observation, it's not a guarantee. And honestly, let's not get too ahead of ourselves. Seasoned investors, the ones we are trying to clone, even these guys make a lot of mistakes. And when I look at the success rate from our study, this is barely over 50%, with a third of their picks ending up in losses. Alright, so to sum this up, and this is entirely my opinion, but I think this version of shameless cloning is a lot better than the previous one for a number of reasons. Firstly, our modified approach uses almost real-time data, which was not the case earlier. The stocks we are referencing, there's no restriction there in the sense that this can be a fresh investment, it can be a top-up, while previously we were limited to the 1% shareholding rule. Thirdly, by using a holding period, the management of cash flow becomes a lot easier, while it was a bit erratic in the previous approach. And finally, by examining rolling returns across periods, I think our expectations are now a lot more realistic, not 41.4%. And I think it's fair to expect an overperformance of about 5 to 7% over the benchmark index. The good thing about this method is that you can start immediately, and this need not be just marquee investors. You can try this approach with FII data, with what mutual funds are up to, even PMS companies, and you can build your own copycat model. Now, I'm sure someone is going to ask me about small case in the comments, so just an update, the RA, the Research Analyst application, has already been filed. I've paid the fee also, and if everything goes as per plan, the license should come in maybe this month itself. I'll keep you all posted on it and would definitely ask for your suggestions before building a model, and if any of you know how to backtest all this, I'll be more than grateful. Please do share it with me. For now, I do hope you found this presentation useful and that you'll be able to use parts of it to improve your own investing strategy. Once again, thank you for your time. Do like this video, do explore alpha, do subscribe to my newsletter, and I'll see you very soon. Until then.